financial literacy, and the human condition. Welcome to Financial Fitness with the Money Doctor, Dr. Francis Rayam.
Hi, it's Francis. I just wanted to take a minute to thank you for watching this video. If you're catching us on YouTube, please help us help others by clicking like, subscribe, and all notifications so you don't miss any videos. And check back for the next video. I think you're going to love it. Thanks again. For more information, you can visit us at hugyourmoney.com.
Welcome to Financial Fitness. I'm Jess Tyler, along with the Money Doctor, Dr. Francis Rayam. Hi.
Hi, Jess. How are you?
I'm good. I feel like we've not seen each other for a little bit, but we're back in action.
It's true. How was your vacation?
It was good. Couple days off, and that's always nice. A little bit of a staycation, you know.
Yeah. This is what happens when you're in radio, right?
Yeah,
somebody else might cover some things, but not enough. So while you were gone, I got some phone calls, a couple of phone calls about credit card rates. Like, how is this not usury, right? We used to throw that term around, usury. It's actually a biblical term, but we used to throw around the word usury, like you can't charge somebody too much money because it's usury. There are usury laws. I think, some people would say loan sharking, right? How do you get to charge? How is that legal? People will say. So I did a little digging about how that is legal because it bugs me too, and I knew some of it, but I will say we'll talk a little bit about the details today, not just about why these interest rates are through the ceiling and how they get away with charging you this, but what can you do about it? I mean, there are things you can do about this.
Okay.
So I think, we always try to tell you a solution to the problem as much as I talk about here's the problem. And I get on my little rants because I get angry about it, that it just seems unfair to me that you should have to pay that kind of interest rate. And, in defense of the large companies, I always say, well, nobody puts a gun to your head to sign this contract, right? We volunteer to get these credit cards. But the other side of the argument is, you may not know what that rate is going to be until after you've applied, first of all. And secondly, rates change. These credit cards have these variable rates. So, you might sign up for something at 0% for a year, or you might sign up for something that had an 8% rate thinking it's always going to stay there, but it's probably linked to some benchmark like Prime or LIBOR or something like that. So it
always
go
seems
up.
like there's fine print too, like you might miss where it says, your interest rate's really low, but if you happen to miss a payment or be late, then it jumps to like 27% for the rest of your life with the credit card. You're like, how did this happen?
Yeah,
and they're covered.
Yeah, it's called the default rate. And we'll go through what triggers that. Because you're absolutely right. You might have a credit card. You always say really intuitive things, Jess. I love having you. So you might have a credit card that's, say, at 16%, and you think, well, it's really high, but I'm doing okay. And then all of a sudden you have this default rate and you're saying, what happened here? And there's a number of things that can happen. So let's start with that. Why not? We're here. The default rate thing. Okay. So the first thing that can happen is you're late on your payment. Now, there are two different kinds of late when we're talking about late on your payment. The one that everybody thinks, I'm afraid of that because it's going to harm my credit. And some people who are very credit conscious say, I don't want to have it past the grace period because it's going to harm my credit. But it doesn't. The grace period, let's define some of these terms that they love to throw around in the fine print that you talked about. The grace period is the number of days between the due date and the date at which they assess a late fee. So let's say that your payment is due on the 1st and you have a 15-day grace period. You're not going to get hit with that late fee until the day of the 16th or 17th, depending on their calendar, right? So they'll apply a late fee for you at that point. They'll apply.
So nice of them, yeah.
They'll apply a late fee to you. They will.
I picture them gleefully behind their keyboards, like late, with like a little smiley face because they get an extra $15.
Wait, 15. Wow.
Whatever.
That's all. 20, 25, 30, $35. Some even higher than that. I had somebody the other day say something about they thought it was $45. I'm not even sure that's legal, but maybe it is. If they're charging it, it probably is. And we'll talk about how those things can be legal. But yeah, they assess that late fee, and now you owe that on top of your balance. And guess what? You owe interest on all of that next month. So That's just the late fee period, that grace period. So if you miss
Okay.
your due date and you miss your grace period, they're going to charge that late fee. It doesn't affect your credit until you're 30 days late.
Okay.
So
Yeah.
if it's due on the 1st of this month, on the 1st of next month, if you still haven't paid it, now they can report you as 30 days delinquent on your credit reports. And
That's good to know because I think a lot of people correlate like if you get a late fee, that automatically means a ding on your credit.
yeah, and it's not. It's a slap on the wrist and some money out of your wallet, but it's not
Mm-hmm.
affecting your credit at that stage. But it will when you get to 30
Mm-hmm.
days late. Now, I could say not everybody reports to the credit reporting bureaus, but pretty much all the national banks, all the credit card companies report to credit reporting bureaus.
Yeah.
So that's one way the default rate can trigger is that
Mm-hmm.
you're late and they want to say, well, they're a high risk. Another way they can trigger it is they can pull your credit reports because you sign up for this, believe it or not. When you agree to this credit card application, one of the things you're agreeing to is I'll let you check my credit, soft check my credit anytime you want, basically. And so they can just soft check your credit uh, as a regular check on you to make sure that you're not a high risk candidate. And if they start to see that your debt to income ratio is too high, they can trigger that default rate.
So they can raise the interest rate even that you signed up for if your
Yes.
credit changes in the period that you have the credit card.
Yes.
That totally seems like that shouldn't be legal.
Well, from their side, if you're trying to protect yourself against bad risk, you want to be able to do that.
I guess,
Some
but they've already said like, hey, we think you're worthy of a $5,000 limit based on this, and then they're gonna change it in the middle of that. I don't know. I
Yeah.
think that's
It's not the same as a mortgage, where
Mhm.
if you get signed up for a mortgage and they have security in your home, for instance,
Yeah,
if you don't pay your mortgage, they can collect, they can
the
foreclose on your home.
foreclosure. Yeah.
So it's not the same as that. They have more risk, which is partly why they charge these high interest rates, because
Mhm.
honestly, they know some default will happen. But
Yeah.
yeah, there are all kinds of little things in that fine print you talked about that cause those rates to go up. Uh, if you're delinquent more than 2 times in a year, they can raise your rate to the default rate. And the default rate could be much higher. Like, let's say that your interest rate on your credit card was capped at 18% for whatever reason, the state law, federal law, whatever it was that capped it at that time in our pretend world of rates right now. And you're delinquent more than 2 times a year or 2 times a year. They can just raise it 28, 30%, Now, the reason we're talking so loosely about interest rates, and I'm saying my pretend world of 18% cap, is because you would think that your state, right, the state that you live in, would
Mhm.
have some laws about how much you could be charged for interest on a credit
Yeah,
card.
regulations for sure. Yeah.
Well, they do. Some
Okay.
states go by contract law, some states go by usury laws. But guess what? The Fed has no cap on it. We
Okay.
have no cap on interest rates under the federal law.
That's scary.
I know, even hearing it come out of my mouth, there's this pause about what do you mean you have no cap on it? So in 1980, I'm trying to think of what it was. Uh, yeah, in 1980, the Depository Institutions Deregulation and Monetary Control Act of
Mhm.
1980, DIDMCA for short.
Okay.
Ronald Reagan was president. We had
Yep.
Reaganomics. 1980, that law weakened the state usury laws and said that even if you said that if a credit card was based out of state,
Mhm.
right? Like, let's say you're in Massachusetts, but your credit card, National Bank, is based in Delaware or
Mhm.
South Dakota.
Yeah.
They can charge you rates based on Delaware or South
Mhm.
Dakota.
Yeah, there's always ways around it so they can charge higher.
There are a lot of exemptions. And so even if your state, like Massachusetts, actually has usury laws in place, and this is a time when I should remind everybody that I'm not an attorney, especially attorneys. If I'm making a mistake, please tell me.
Yep.
So yeah, or give me additional information. I would love to hear about this one. This one's fascinating to me. So Massachusetts had those laws in place, and I think it was 18% in Massachusetts. I'm not positive of that, but I'm pretty sure it was 18%. But because of the federal laws, they can charge whatever they want, basically, based on the state they're incorporated in. Now, many national banks, if you look at your credit card statement, you'll see Delaware, South Dakota, Delaware, South Dakota. And what else? Delaware and South Dakota. Because the laws there are so loose about what they can charge. I will say, the Attorney General has a consumer guide about this. And if you're at all a geek, or if you're just interested in learning more about this, I'll give this again at the end, but you should check out that guide. It's an Attorney General's Guide to Consumer Credit. And there's a phone number too, which is 617-727-8400 that people can call. And I'll give that again at the end so people can take it down. But there's so much to this. And I did say that we would talk about the things that you can do to counteract this. And there are things you can do. But I think it's important to just remember that at a federal level, national banks are, I don't want to say more protected than consumers, but they have a huge lobby. And there's a lot of money at stake here. So if you think about this like a court case, you're going to go up against a national bank in court. How do you think that's going to fare?
Mm-hmm.
First of all, they can outlive you.
And the hard thing is too, we've talked about this before on previous shows, but when you look at some of those companies that can charge 30% or whatever they want for a really high interest rate, it's usually the people that are desperate for credit or money at that point that are going to get those cards. So I just feel like maybe you don't look at the red flags as hard if you really are in a situation where you need it.
It's an interesting twist because I'm often defensive for my clients, right? For the public about this impression that is given to us, the stigma about debt, which is just what you said. The people who are in the most trouble, who are the most desperate, will accept those rates. But I'm going to say not quite the case always. In fact, often not the case. And here's what people don't understand. When I talk to people who have no debt or who had lots of money and never had a problem with money, they often are judgmental about people who get into monetary problems. And they say, well, what were they thinking? Why were they so irresponsible? And well, they just signed their name and bought campers on credit cards. Sometimes that's the case, but often it's not the case. And the hard fact here, the hard reality is that if that was really the case, then we would only have people with terrible credit in desperate situations paying high interest rates. And that is not true. We have well-meaning people who go to work every day, pay their bills, try to save what they can, send their kids to school, try to be a good neighbor, and they're paying these interest rates. And it happens because of what we talked about earlier. It's not the same as your mortgage. You can't rely on it like a fixed rate loan. These companies have variable rates. So what happens? First of all, if you're really desperate and you have bad credit, you may not be getting approved for that credit card.
Right.
Maybe you will, but it's likely that if you're in that bad a shape, you're not getting that credit card anyway. So it's the middle of the road people. It's the people. I mean, who do you want if you're a national bank? You want people who are going to pay their bills, who can tolerate it when you jump that rate to 30%. And in the second half, we should go into how credit card companies design their minimum payments, because it isn't necessarily tied to that interest rate. So what happens, Jess, is that you get people who are well-meaning, who take on a credit card because they need to, or they find it a good idea to do. And they maybe accept a 15% interest rate, let's say, and they're chugging along just fine. And then bam, something happens and they miss a payment. They miss 2 payments, right, in the year.
Yeah.
And it defaults to that rate. And now they're stuck with that balance at a new 36% rate or whatever it is. And that's how that happens to people. And then because the rate is so high and the payment is so low, because of the way they're not tied together, which we'll talk about, that's where you start to get into the quicksand. So it really isn't, in my opinion and my experience, it's not about, poor money management at the beginning, taking on a credit card with a high interest rate.
All right. I've got a couple questions on that for you, and we'll have much more. But first, I want to get your phone number.
Sure. It's 413-773-3333.
And you can go to hugyourmoney.com. We'll be right back with part 2 of Financial Fitness with the Money Doctor, Dr. Francis Ram, right here on WHMP.
Tired of juggling your finances? Your Hug financial coach can help. Hug Your Money. So unique, It's patented. For more information, visit hugyourmoney.com.
Welcome back to Financial Fitness. I'm Jess Tyler, along with the Money Doctor, Dr. Francis Ram. Hi.
Okay, Jess. So, when I thought to myself this morning, we're going to talk about credit card interest rates, I thought, is this really an interesting topic? And then I decided whether it's interesting or not, it's valuable. People need to hear why this happens, what they can do about it. And so I promise you, we won't close this show without giving you some specific things you can do about it and some details on it. But before the break, I mentioned we should talk about how these credit card companies calculate their minimum payments.
It's not based on the balance?
It's based on the balance, but most people think it's based on the interest rate. So they think when my interest rate is higher, my payment is going to go up. Well, that would be logical. That's the way most loans work, right? If you had a variable rate mortgage and your interest rate goes up, so does your payment.
Right.
Okay. But credit card companies, I love that we call them credit card companies. You know what? These are banks. Some different company that issues a credit card. These are the same banks giving you your mortgages and your automobile loans, but now they're charging you for credit cards. And we separate that so that we don't blame them psychologically. I don't want to get my loan from a bank. I want to get it from a bank. I don't want to get it from a credit card company. Same thing.
Same thing. Okay.
Yeah. I mean, let's be honest about it. They're national banks. A good example is Chase. You can get a mortgage from Chase. You can get a car loan. You can get a credit card, right? It's a national bank. Okay. So, but I like to refer to them as my little cuties. These credit card companies, these little cuties, they love to do things a certain way. And one of the things they do that is so dangerous for people, and why we say stay out of credit card debt or get out of credit card debt if you can, is this. All right. When your interest rate goes up, let's take a credit card with a $10,000 balance. Okay. When you sign up, let's say it's a 0% rate. Let's just make things simple. It's 0%. You sign up for a $10,000 credit card and you get your bill in and it says your minimum payment is $200. Okay. So you pay $200. That is basically, well, not basically, it's exactly 2% of your balance, right? There's no interest rate on it. It's zero.
0%.
2% of 10,000 is $200. Okay. Let's suppose the interest rate jumps up because of one of the things we're talking about, or just that, they've reviewed the account and the interest rates are going up. Maybe the interest rate expires, the 0% rate expires, and now you're at prime plus whatever. When you're enrolling for these cards, it'll tell you that you're going to go prime plus whatever. So let's say prime is at 3% and they're going to add 12% to it. So now your interest rate jumps from 0 to 15%. Your payment may or may not go up from $200.
But only so much is going towards the principal, right? And the other is going towards interest?
Yes. And if it does, it may go up slightly. So for an example, that same $10,000 balance with a $200 payment on it at 0% might now have a 15% interest rate, but your payment might be $220, $225.
Okay.
So this is where it gets dangerous because what happens is, of course, what you said. Now, more money is going to interest, less to principal. And if you start to look at an amortization schedule, which is fancy talk for the schedule of how each payment is broken down over time, how much goes to principal and how much goes to interest and how your balance drops. If you look at that amortization schedule, you will see these credit cards stretch out beyond your wildest dreams. It's really common for us to say to people after looking at all the debt they put in the system, oh, I see you have a mortgage, some credit cards, some student loans, and a car payment. Yeah, it's going to take you 37 years to get out of debt. And they'll say, why 37 years? My mortgage is a 30-year mortgage. It's my biggest loan, and I've been paying it for 10 years. Take a look at those credit cards. The hardest part about that is that unless you call the company, you get to a supervisor who knows what you're talking about, and you say, I want to understand, if my interest rate goes up, how do you increase my payment? Unless you can really get to somebody who understands that, you're going to get the same answer, which is, oh, well, we charge you, and they just read it off the fine print.
Right.
Charge you prime plus whatever. Yeah. But you don't make your minimum payment based on that. Yes, that's what you're charging me in interest. But if you're not adjusting the payment in relation to that, it's taking me longer and longer to get out of debt because you're just taking more interest from me. And
Right.
people don't understand it. And I may not have done the best job of explaining it here, but I hope I've caused people, some pause to think about, oh yeah, that's the problem. The other thing is we talked about 0% cards. You could have that 0% card for a $10,000 balance and a $200 payment. And you could actually move that debt to, well, let's do it in reverse. You could have an 18% card with $10,000 on it and a $200 a month payment, because they're calculating that payment based on your balance, not on your interest rate. If it factors in, it factors in a little bit. So let's take that idea. You're about ready to play the credit card game. You have a $10,000 balance at 18%, and you're paying $200 a month. So you call around and you get a card that says you can move it to 0%. It may or may not have a 3 or 4% fee to transfer it, right? On which you're going to pay credit. So you're going to bring your balance up by 3 or 4%, and then you're going to pay interest, excuse me, not credit. You'll pay interest on top of that. But that's aside from the fact for this scenario. So let's say you move that 18% to a 0% card. Now you're really happy. You got 0%.
And I know a lot of people that do that.
Yeah. So that may be a good thing. You're going to pay less in interest. But what happens if money is tight, and when your bill comes in, because of the way that credit card company calculates their minimum payment, maybe they charge you 4% of your balance. And now your minimum payment has gone from $200 on the 18% card to $400 on the 0% card.
Okay. So you need to look into all of this stuff before you start to transfer stuff thinking you're going to get a better payment.
Yeah. Have I numbed you with numbers? I'm sorry if I have.
No.
I just want people to understand that there's more to think about than just the interest rate. In the scenario I just gave you, are you paying down your principal faster? Yeah, you got a 0% rate and you're whacking $400 a month on it. Of course, you're paying it down faster. That's great if you can afford to do it. If you cannot, you've just put yourself into a danger zone.
All right, question. I think I probably know what the answer to this is, but I know we were talking about if you have credit and you got approved for $5,000 at a low interest rate, and then somehow you made a late payment or whatever, and they decided to adjust it. Do they ever adjust it the other way? Like your credit has gotten better over the terms of the credit card, and then they say, oh, you're doing really good. We're going to lower your rate to 5%.
I don't know that I've ever seen it automatically adjusted lower. It might happen. But I do see offers go out to people saying, you've been a strong customer with a good customer with a strong history, and we're offering you another card with our company at a lower rate. And they often will switch the balance, move the balance for you from one card to the other as a courtesy. Mostly you have to ask for it. You're absolutely right about that.
And then the other question I had, go ahead.
No, please.
The other question I had for you is just when you're thinking about getting a credit card, what would you say is a good range of rates? Like, would a red flag go up if it was above 16%, 18%, 10%? What's like the good range of like, these are good ones to get, and then stay away from these at all costs unless you absolutely have to?
That's a really good question. And again, we're looking at this from interest rate only. And so I would say, of course, you want something that has a lower interest rate, but don't look just at what the current interest rate is. Look at that fine print that says, what will it default to?
Okay.
And what is it based on? Is it prime plus 12% would be more appealing to me than a credit card that is prime plus 16%, right? Because you know what they're using as a benchmark. You know what they're using as a factor to go up. But the main thing I want you to ask, especially if you're worried about money getting tight at some point, which, let's be honest, you're not looking at a credit card unless you don't have a lot of cash hanging around usually. Right? Unless you're like me and some of the people that are out of debt who just use it for points and then turn that in for cash and make the credit card company pay you. That's always really fun.
Nice. Yeah.
Made Chase pay me last year quite a bit of money. That was really fun. But it can also be dangerous if you don't have the money hanging around to just pay that. You don't want to get into that. But the thing that they don't tell you on those applications, and you will have to call and you will probably have to get a supervisor to find this out, is aside from the interest rate, what will your minimum payment be?
Okay.
They don't tell you for a reason, right? First of all, they don't have to, because they don't know until you've applied what your real interest rate is going to be. So they can always hide behind, well, we have this factor of this and factor of that. But really, you just want to know. When I have people who are struggling and we have to move credit from one card to another, which we don't do that often, but when I have to recommend that as part of a solution, I'll ask them to look for a credit card that has this payment. And this is very dangerous. So outside of our program, if you find a credit card that charges you, let's say 1% of the balance, so that $10,000 balance is now a $100 monthly payment, that can be very dangerous, although it's appealing, if the interest rate is relatively high because you can't get it paid off at that rate. If they're charging you 18% interest and they're allowing you a payment of 1% per month,
you're going to be paying on it forever.
Going backwards. You only get 12% in interest for the year and you're going backwards, right? So most companies won't let you go backwards. They'll charge you the interest plus a tiny little bit. But the way you beat that, and these things I wanted to talk about how you can beat this game, beat them at their own game. The way you can beat that is to use a system like ours. Oh, excuse me. I'm sorry, folks. The way that you beat that is to use a system like ours where you can speed up the process. So you can tolerate that low payment, even if it's at a high interest rate, because overall you end up, most of our clients are paying less than 3%, right?
Okay.
You can use a system like this, a money management system, to beat that interest rate down to an affordable range for yourself, which is different than just negotiating, although that is one of the things you can do. So you can use a system like ours. You can negotiate. So you can call your lender and say, I want a lower interest rate. I deserve a lower interest rate. By the way, how will that adjust my payment, if at all? Right?
Okay.
And really use that to your advantage. You can switch users. You can say, you know what? I'm just tired of paying you people and you're not being very nice to me and I'm going over here to this other bank. And so you can switch users. And you can transfer your balance, of course. You could say, look, I want to transfer my balance from here to another card and find a card that has some of the features that we're talking about that are useful. And also, if you're in the military, you can take advantage of that Service Members Civil Relief Act that we talked about a couple of shows ago, or that I talked about when you were away, and also the Military Lending Act. So the Military Lending Act says for active duty members and their qualified dependents, they pay no more than 36%. I know that's horrific, but 36% on loans. And the Service Member Civil Relief Act says on your credit cards, if you got that credit card debt before you became active, 6%. But you got to ask for them. You have to ask for them. And again, if you want to read up on this stuff, you can just Google it. But a shortcut would be to go to the Attorney General's site and read that consumer guide, or call them and find out about it, or you can contact us. But, one way or the other, I just want people to be empowered a little bit about this. Don't feel like there's nothing you can do. Go in eyes wide open. I like wise eyes wide open. Go in eyes wide open and make sure that not just what your interest rate is going to be, but what your monthly payment is going to be. And what it will go to. Yeah.
A lot of info to take in, but all good because everyone uses a credit card at one point or another. So all of these things are things you need to know. If people have more questions, how can they get a hold of you?
Sure. They can reach us at 413-773-3333.
Perfect. You can also go to hugyourmoney.com, and we'll be back again next Saturday with another edition of Financial Fitness with the Money Doctor, Dr. Francis Ram, right here on WHMP.
Would you like to see your business on Financial Fitness with the Money Doctor? We offer a 15-year proven track record. We have limited openings, but are currently seeking sponsors and guests. Is your business a good fit? We'd like to start a conversation. Contact us today at 413-773-3333 or info@hugyourmoney.com.